Hello, in this short video I would like to discuss the time value of structured products. Let's start with a simple example, the standard call option. Generally speaking, the time value of a structured product is defined as the difference between the value of the product at issuance and the value at maturity. As you can see in the payoff chart here, the call option has positive time value because the payoff at issuance is above the payoff at maturity. Now, when a product has positive time value, it means that time works against me when I'm invested in the product. And you can see that here when I move the time scale towards maturity, the positive time value, which is indicated with this shaded area, is slowly disappearing. So positive time value means time works against me as an investor. Now, generally speaking, the time value of structured products has two subcomponents, the financing component and the opportunity component. The financing component is due to the fact that when interest rates are positive, time is money. And that also means that the time value will change with interest rates. So if I increase interest rates here, the time value increases because with higher interest rates, time is even more money. The opportunity part of the time value is due to the fact that the call option here is a convex payoff. And convex payoffs offer the opportunity to outperform the underlying. So time means opportunity for me. Now, and this opportunity value typically increases with the volatility because the more volatile the underlying is, the more likely it will be that I can profit from this convex payoff. So this is a simple example. Let's move to another example. Going back to the menu, let's take a look at the barrier discount certificate. Now, the barrier discount certificate, it has a concave payoff. So concave is the flip side of a convex payoff. It's kind of the opposite. And what we can see here, typical for concave payoffs, they have negative time value, which is the light shaded area here, which means as time elapses towards maturity, time works in my favor. It works in my favor. So why do concave payoffs have negative time value? Well, as I said, it's the flip side of convexity. Concave payoff, they basically expose you to the risk of underperforming to the underlying asset, and therefore time represents a risk. And as time elapses, this risk becomes smaller. That's why time works in your favor. Or to be a bit more precise, if we look at the replicating portfolio of this product here, we see this product is replicated by a long zero bond and a short barrier option. And as time elapses towards maturity, the zero bond typically gains in value when interest rates are positive, and the short put option with time elapsing towards maturity is becoming less and less risky. That's why both of these subcomponents typically gain value with time towards maturity. Let's take a look at the last example, the capital protected certificate with double knockout. This is really an interesting payoff because you can see it has some parts positive time value, which is the dark shaded area, and in some areas it has a negative time value, which is the light shaded area. And this is because it's kind of a mixture of convex and concave payoff parts. So it's a kind of a mixture of both. That's why we see positive and negative time value in one payoff chart. And when we go towards maturity, you can see that both the positive and negative time value disappears. To sum it up, time value is the difference between the value at issuance and maturity. It can be positive, which is often the case, typically the case for convex payoffs. In that case, time works against you as an investor. Then we have concave payoffs, where time value is typically negative, which means as an investor, time works in your favor. That concludes our introduction. Thank you for watching and goodbye.